There is a moment in history when a single number tells the entire story. Most people miss it, not because they are not paying attention, but because they are looking in the wrong direction. Right now, in the middle of oil crises, wars, and political uncertainty, one number quietly appeared in a trade report that most financial analysts scrolled past without a second thought. China, in a single month, imported more silver than it has ever imported before in its entire recorded history. That is not a small statement. That is not a routine economic update. That is a signal. And history has shown that when China moves like this, the world eventually follows. To understand why this matters, one must first understand how China operates. China does not make economic decisions the way most Western nations do. It does not react to markets. It positions itself ahead of them. While retail investors and even institutional traders respond to headlines and short-term price movements, China studies decades. Its economic planners think in 10-year, 20-year, and even 50-year cycles. When China begins accumulating a resource at record levels, it is not because a factory manager placed a large order. It is because somewhere at the highest level of strategic planning, a decision was made. And that decision was made because they can see something on the horizon that most of the world has not yet noticed. Now, the mainstream financial media has been quick to offer a simple explanation for China's silver purchases. They point to solar panels, they point to electric vehicles, they say China is the world's largest manufacturer of green energy technology, and that silver is a critical industrial material used in solar cells and EV components. This explanation is not wrong, but it is deeply incomplete. And the danger of an incomplete explanation is that it gives people a reason to stop asking questions. It gives them a comfortable story that fits into what they already understand. And the moment people stop asking questions is the moment they become vulnerable to the very shifts they failed to anticipate. Yes, silver is used in solar panels. Yes, China is manufacturing those panels at an extraordinary scale. But consider this carefully. China has been building solar panels and electric vehicles for years. The manufacturing capacity did not suddenly double overnight. So why did the silver imports break records specifically last month? Why now? Why at this particular moment in global history, when the Strait of Hormuz is closed, when petrodollar agreements are being openly questioned, when central banks around the world are stacking gold at the highest levels this century? The timing is not a coincidence. The timing is the message. To read this signal correctly, one must look at what China did with gold over the past 2 decades. For years, economists and analysts underestimated how aggressively China was accumulating gold reserves. The purchases were spread across different channels. Some went through the central bank. Some moved through state-owned institutions. Some were absorbed into private markets under government guidance. By the time the full picture became visible to the outside world, China had already positioned itself as one of the most gold-rich nations on earth. The playbook was patient, deliberate, and executed with extraordinary discipline. And now, those who study these patterns closely are beginning to ask a deeply uncomfortable question. Is China running the same playbook with silver? There is one critical difference between gold and silver that makes this situation even more significant. Gold is primarily a monetary asset. It sits in vaults. It backs currencies. It signals financial power. Silver, on the other hand, is both a monetary asset and an industrial one. It sits at the intersection of finance and technology. It is inside the infrastructure of the modern world. If a nation controls enough silver, it does not just hold financial leverage. It holds industrial leverage. It holds the ability to influence the pace at which the rest of the world can build clean energy systems, manufacture electronics, and develop the technologies that every growing economy now depends on. This is the signal that most investors are ignoring, not because it is hidden, but because it does not fit the simple narrative they were offered. The record silver imports out of China last month are not a story about factory orders and supply chains. They are a story about positioning. They are a story about a nation that has studied the history of every great economic power that came before it and has decided that the next phase of global influence will not be won on a battlefield. It will be won in a commodity market, in a trade agreement, and in a resource stockpile that the rest of the world will one day desperately need. The question now is not whether China is making a move. The question is whether anyone else is paying attention in time. There's an old Chinese proverb that says, "The best time to dig a well is before you are thirsty." Most nations wait until the crisis arrives before they begin looking for solutions. China does not operate that way. China digs the well years in advance, quietly, without announcement, without press conferences, and without inviting the world to watch. What the world is now beginning to realize is that China has been digging a very specific well for quite some time, and silver is the water it is designed to hold. To truly understand the architecture of China's silver strategy, one must separate the official explanation from the strategic reality. The official explanation, the one offered by trade analysts and commodity reporters, is straightforward. China needs silver for its green energy revolution. The country has committed to massive solar energy expansion. It has pledged to put hundreds of millions of electric vehicles on its roads. Silver is a core material in photovoltaic solar cells and in the electrical components that make modern vehicles function. On paper, the import numbers make complete industrial sense. A nation building at that scale needs materials at that scale. Case closed. Story explained. Move on. But serious economic thinkers do not move on that quickly. They ask the next question, and the next question is this. If China's silver demand is purely industrial, why are the purchases being structured the way they are? Industrial procurement follows production schedules. Factories order what they need, when they need it, in quantities that match their output timelines. What China is doing does not match that pattern. The volumes are exceeding immediate manufacturing requirements. The pace of accumulation is faster than production demand alone can justify. And when accumulation exceeds immediate need, there is only one logical explanation. The excess is being held in reserve. And reserves are never industrial. Reserves are always strategic. This brings us to the second layer of China's silver strategy, and it is the layer that almost nobody in mainstream financial media is discussing openly. China is watching the global monetary system with extraordinary attention right now. The de-dollarization movement, the gradual but accelerating effort by multiple nations to reduce their dependence on the US dollar as the world's reserve currency, is no longer a fringe theory. It is a documented geopolitical reality. The United Arab Emirates, one of the most significant oil-producing nations in the world, has recently threatened to abandon the petrodollar peg and conduct oil trades in Chinese yuan instead. This is not a small development. This is a fracture in a financial architecture that has defined global trade since the 1970s. China understands that if the dollar loses its dominant position in global trade, the nations that hold the right alternative assets will hold the power. Gold has already been identified as the primary alternative. Central banks worldwide are stacking gold at the highest levels this century precisely for this reason. But China is thinking one step further. It is positioning silver not just as an industrial material, but as a secondary monetary hedge, a complementary asset that holds value, carries industrial utility, and remains undervalued enough that large accumulation is still possible without triggering immediate global alarm. Gold at current prices attracts enormous attention. Silver, still relatively affordable on a per-ounce basis, can be accumulated quietly, and quiet accumulation is exactly how China prefers to operate. To see this strategy in its full clarity, one must revisit how China handled gold over the past 2 decades. For years, China's official gold reserve figures remained suspiciously stable, while gold was quietly moving through state-owned banks, sovereign wealth channels, and government-guided private institutions. By the time China began officially updating its reserve figures, the accumulation was already largely complete. The world was informed after the positioning was secure. This is the pattern. Accumulate first, announce later. And by the time the announcement comes, the leverage is already locked in. Beijing's internal economic forecast is being revealed not through speeches or policy documents, but through purchasing behavior. When a government buys a commodity at record levels during a period of global uncertainty, it is communicating its expectations about the future value of that commodity. China's planners are not buying silver because they think prices will stay the same. They are buying silver because they believe the world is entering a period where silver becomes significantly more scarce, significantly more valuable, and significantly more difficult to obtain at current prices. They are not reacting to the future. They are buying it. The architecture of this strategy is now visible to anyone willing to look beyond the surface. China is not simply purchasing silver. It is purchasing optionality. It is purchasing the ability to influence global supply, to anchor its green energy dominance, to hedge against dollar instability, and to hold a critical industrial asset at a time when the rest of the world will need it most. Every record-breaking import figure is not just a trade statistic. It is a brick in a structure that is being built with purpose, patience, and a precision that the rest of the world has consistently underestimated. The architecture is nearly complete. The question now is what happens when the rest of the world finally looks up and realizes what has been built. History has a pattern that repeats itself with uncomfortable consistency. Every time the world becomes distracted by conflict, by crisis, by the noise of geopolitical tension, there is always one nation somewhere that is not watching the fire. It is studying the smoke. It is calculating wind direction. It is quietly identifying which resources will become most valuable once the flames eventually settle. Right now, the world is watching the Middle East. It is watching oil prices, ceasefire negotiations, and naval standoffs in one of the most strategically critical waterways on the planet. And while that attention is fully consumed by the visible crisis, China is accelerating a strategy that the crisis itself is making more urgent, more logical, and more irreversible by the day. The Strait of Hormuz is not simply a geographic location. It is the throat of the global economy. Approximately 20% of the world's oil passes through that narrow waterway every single day. When it closes, even partially, the entire financial world reacts immediately. Oil prices rise. The dollar strengthens as investors seek safe haven. Precious metals face downward pressure in the short term as the dollar gains dominance. And on the surface, this appears to be bad news for silver. The headlines confirm it. Silver retreats as Middle East tensions bolster the dollar. Gold falls as Hormuz tensions send oil higher. These are the headlines that most investors read and respond to. But China's economic strategists are not reading those headlines the same way retail investors are. China reads a closed Strait of Hormuz as a confirmation that the global energy infrastructure is fragile. It reads rising oil prices as evidence that nations dependent on Middle Eastern energy will face increasing economic vulnerability. And it reads the dollar's short-term strengthening as a temporary reaction inside a long-term structure that is fundamentally weakening. Every time there is a geopolitical crisis of this magnitude, the argument for alternative assets, alternative currencies, and alternative energy sources becomes stronger. Solar energy becomes more attractive when oil becomes more expensive and more politically unstable. And the material at the heart of solar energy is silver. China is not alarmed by the Strait of Hormuz crisis. In a strategic sense, the crisis is working in its favor. The ceasefire situation adds another layer to this accelerating picture. When the United States announced that the ceasefire was ending and that a further extension was highly unlikely, markets experienced immediate uncertainty. Gold and silver moved, oil responded, the dollar shifted. But underneath all of these short-term price movements, a deeper reality was being confirmed. The Middle East is not stabilizing. The conflict is not resolving. And prolonged instability in the world's most critical energy region does two things simultaneously. It weakens confidence in the petrodollar system that has governed global trade for decades, and it strengthens the case for nations to build energy independence through alternative sources as quickly as possible. Both of these outcomes point directly towards silver. Now consider what is happening with global central banks at this exact moment. Central banks around the world are holding more gold than at any point this century. This is not an accident, and it is not a coincidence of timing. Central banks accumulate gold when they are preparing for a period of significant monetary system stress. They are not buying gold because everything is fine. They are buying gold because the people who manage national financial systems at the highest level are looking at the same geopolitical landscape and concluding that the existing framework is under serious strain. China has been a leading contributor to this gold accumulation trend. But as previously established, China is now extending that same logic to silver. If gold is the primary defensive asset in a monetary crisis, silver is the strategic offensive asset in an industrial and technological one. The United Arab Emirates situation deserves specific attention because it represents something that would have been considered almost unthinkable a decade ago. One of the most powerful oil-producing nations in the world, a country whose entire economic architecture was built around dollar-denominated oil trade, is now openly threatening to sell oil for Chinese yuan. UAE officials have publicly requested access to US dollar swap lines and have made clear that if dollar funding becomes constrained, they are prepared to shift their oil transactions away from the dollar entirely. This is not a negotiating tactic from a small economy. This is a structural warning from a nation that sits at the center of global energy commerce. And the fact that this warning is being issued publicly, not behind closed doors, signals that the erosion of petrodollar confidence has reached a point where even America's closest regional partners are openly reassessing their position. China is watching all of this with the patience of a nation that has planned for exactly this moment. The geopolitical chaos unfolding across the Middle East, the crumbling confidence in dollar-denominated energy trade, the accelerating shift toward alternative energy systems, and the record-level gold accumulation by central banks worldwide are not separate stories. They are chapters in the same story. And that story is the story of a global monetary and industrial order that is in the early stages of a fundamental reorganization. China has positioned silver as one of its primary tools for navigating and shaping that reorganization. Every conflict, every sanction, every closed waterway, and every threatened currency peg is not a disruption to China's silver strategy. It is an accelerant. The world is providing China with the perfect conditions to complete what it started. And the most remarkable part of this entire situation is that it is happening in full public view, inside trade reports and commodity import statistics that are available to anyone who chooses to read them carefully. The geopolitical fire is burning loudly, but the real story is in what China is doing in the silence beside it. There is a specific moment in every major economic shift where the window of understanding is still open, where the data is visible, the pattern is readable, and the time to make informed decisions still exists. That moment is now. But windows do not stay open indefinitely. History has shown with brutal consistency that the nations, the institutions, and the individuals who recognize a structural economic shift, while it is still forming, are the ones who survive it with their wealth and influence intact. The ones who wait for confirmation, who wait for mainstream headlines to validate what the data already revealed months earlier, are the ones who arrive at the conclusion too late to act on it. The story of China's silver accumulation is still in its early chapters, but the later chapters are already being written. To understand what this means for the global economy, one must first accept a truth that is deeply uncomfortable for Western financial thinking. The assumption that silver is simply a commodity, a material that rises and falls in price based on industrial supply and demand, is no longer sufficient as an analytical framework. China has elevated silver into something more complex. By accumulating it at record levels, by linking it to its green energy dominance, by connecting it to its de-dollarization strategy, and by timing its accumulation during a period of maximum geopolitical disruption, China has effectively transformed silver into a geopolitical instrument, and geopolitical instruments do not behave like ordinary commodities. They behave like leverage. Consider what happens to global silver supply chains as China's accumulation continues at its current pace. Silver is not an infinitely abundant material. Global mine production has been relatively flat for years. Above-ground stockpiles have been declining as industrial demand from multiple sectors increases simultaneously. Solar energy manufacturers need it, electric vehicle producers need it, electronics companies need it, medical technology requires it. And now, on top of all of this existing demand, China is pulling silver out of the global market at record speed and holding it. The mathematics of this situation lead to one unavoidable conclusion. At some point, the rest of the world will look for silver and find that there is significantly less of it available than they expected. And the nation holding the largest reserves will set the terms of access. This is not speculation. This is the same story that has played out with oil, with rare earth minerals, and with semiconductor manufacturing capacity. Every time a single nation achieves dominant control over a critical resource, the rest of the world discovers the true meaning of strategic vulnerability. Europe learned this lesson with Russian natural gas. The global technology industry learned it with rare earth elements when China restricted exports in 2010, and the entire world scrambled to find alternative sources. The pattern is not new. Only the resource changes. And today that resource is silver. For Western economies, the implications are serious and immediate. The United States and European nations have built their green energy transition plans around the assumption that the materials needed to execute those plans will be available at manageable prices through open global markets. Solar panel manufacturing targets, electric vehicle production timelines, and national energy independence goals all depend on stable silver access. If China's accumulation continues to tighten global supply, those timelines become unrealistic. Those targets become unachievable. And the green energy transition, which is already a politically sensitive and economically complex undertaking, becomes even more difficult and more expensive. The nations that did not secure their silver supply early will find themselves negotiating from a position of weakness with the nation that did. For businesses and entrepreneurs who are paying attention right now, this situation contains both a warning and an opportunity. The warning is straightforward. Any business operating in the solar, electric vehicle, electronics, or technology manufacturing space needs to take its silver supply chain far more seriously than it currently does. The era of assuming that raw materials will always be available at current prices through current channels is ending. Supply chain vulnerability is no longer a risk management footnote. It is a central strategic concern. Companies that do not build supply chain resilience into their long-term planning today will face a crisis that their competitors who planned ahead will not. The opportunity exists on a different level. Silver at its current price still represents one of the most asymmetric opportunities in the commodity world. It is the only asset that sits simultaneously inside the monetary system and inside the technology infrastructure of the modern economy. It is undervalued relative to gold on historical ratio measures. It is an increasing demand from multiple industrial sectors that are not going away. And it is now being accumulated by the most patient and strategically disciplined economic power on the planet. When the largest economy in the world by purchasing power decides that a specific asset is worth breaking records to acquire, serious investors do not look the other way. They ask why, and then they act on the answer. What China is doing with silver is not a mystery, it is a message. It is a message written in trade statistics and import records and commodity flows that anyone with access to public data can read. The message says that the global economic order is reorganizing, that the dollar-centric framework that has governed world trade for 50 years is under genuine structural pressure, that the nations and institutions which position themselves correctly during this transition will hold significant influence over what comes next, and that silver, humble and underappreciated silver, is one of the primary instruments through which that positioning is being executed. The global economy is standing at an intersection. One road leads forward into a world where alternative assets, alternative energy systems, and alternative currency frameworks define the new order. The other road leads backward into the assumption that the old system will hold, that the dollar will remain unchallenged, and that silver is nothing more than an industrial metal. China has already chosen its road. The record import figures confirm it. The green energy manufacturing dominance confirms it. The de-dollarization alignment confirms it. The only question that remains is what the rest of the world will do with the time it still has to respond. That time is measurable. It is not unlimited. And the window, as history always reminds those who study it carefully, does not stay open for long.